I mean, it's just exhausting. Not only is the SPY falling, but now we've gotten disasters over jobs and oil, and we still have this Credit Suisse drama going on. Folks, let's talk about what's going on. All right, look, the first thing that you got to know this morning is that yesterday, when we talked about how we're starting to see some softness in the job market, it was true. We started to see in multiple reports that companies are seeing less quits. The JOLTS report came in softer than expected, which was phenomenal. That's the job openings and quits report and so on. That came in softer, as well as anecdotal evidence from companies that, hey, we're not needing to fill jobs as much, we're seeing less demand, or we're able to fill jobs and less people are quitting, right? Like, what we were getting anecdotally from the New York Times and from other resources that we were looking at yesterday for jobs, combined with the JOLTS report, was saying, hey, like things are actually going in the right direction. But in my video yesterday, I cautioned that we can't just look at one report and say that's it, the Fed's going to pivot. Because the Fed wants to see a consistent slew of many, many reports that are showing an actual balance in the labor markets. And that is exactly what we did not get today. Quite literally what we did not get today. Now, today is just sort of the forerunner to what happens on Friday, but we still want to talk about it because it's not that terrible at making estimates. You know, this whole post-COVID period has been a little rougher to make estimates, but still, this morning we got the Adp Jobs Report, which is great because it showed that, yes, the bars are trending down. As you can see, U.S. employment growth has slowed since last spring, right? We are seeing this trend. See, if I were to draw a trend line, we're seeing a trend down. But unfortunately, we actually, in this last report, ended up seeing the number of jobs come in not only higher than expected, but higher than where we were in August. And so it's this kind of flip-flopping that the data is doing, even though it's trending down, much the same with inflation, trending down, at least recently here, but flip-flopping, that leads the Fed to be reiterated or sort of reaffirmed that, this is why we have to continue hiking. Because here are the actual numbers. So the report right now showed a 200,000 job gain as the expectation. We actually beat the expectation, so the economists are wrong again. Not only were the expectations 200K, but we came in at 208. Now that's not that terrible, but when you combine that with the fact that they went back to last month and added and revised up the amount of jobs we had last month, which they do, they make revisions, you know, as more data comes in, they make revisions. They revised up the jobs last month by another 185,000 jobs. So what we actually end up with is a pretty decent job growth picture, where even though things are slowing down off of their crazy shortages, they're still strong. In fact, the report also told us about wage growth, and the wage growth numbers, quite frankly, were scary. Those who changed jobs experienced a 15.7% pay increase from a year ago. That is compared with a 7.8% gain for those who stayed at their job. Remember what we talked about yesterday with the wage price spiral. And this, by the way, is why you want to consistently come back, hit that subscribe button, watch all the videos, because we build here, okay? We're like Lego builders. Anyway, wage price spiral is what we talked about yesterday, right? If the ADP report is saying people who stayed at their jobs gained 7.8% in wages, that's almost where the inflation rate is. And if you change jobs and you basically doubled your wage increase, well, that is now a significant potential wage spiral that says let's just keep quitting every year and get more money, right? On top of that, we find that nearly 3/4 of the increases that we had were driven by a surge in transportation, utilities, and trade. Manufacturing and mining declined, but, you know, overall, it's still like, all right, so you got some parts going down, others still strong. More ammo for the Fed to stay strong. We also did see payrolls fall in financing activities, which that's no surprise, because then when we bring up this idea of Credit Suisse, we have some other news this morning as well. We got to cover the other news. But when we bring up Credit Suisse, oh my gosh, the debates on Twitter are just quite frankly exhausting. Look, this is why what I prefer to do is do fundamental analysis rather than just debate speculation. And that's why today in the course member live stream, we're going to be doing a fundamental analysis on Shopify. I'll tell you, man. We're trying to get this, the new, remember how I said, like, we're trying to transition to this new course, and we're making a big change to the course model. Well, some of that involves using Shopify, and I have to say, I'm really impressed with Shopify. So we're going to do a fundy analysis on them. Anyway, yeah, that course update is still coming. It's going to be really exciting. But beyond that, look, this whole Credit Suisse debate nonsense. Oh my gosh, watch my video on Credit Suisse, because I understand people making the comparisons to Lehman Brothers. Oh no, the numbers somewhat aligned. We gotta be careful, because remember that when we look at credit default swap charts, those can spike when companies just straight up suck, not necessarily signs of systemic-wide crises. Now, it's not to say put your head in the sand and everything's fine, you know, like our total global financial system's gonna be fine. After all, we saw the UK had to get bailed out by the Bank of England, right? And we were definitely seeing drama around markets, especially the real estate market in China. And now you've got some relatively large banks cracking, essentially. But when you look at the financials of this company, they suck at running the business. That's all I gotta say. That's all I gotta say. Actually, I got a whole video on what I say. The other thing that we have to pay attention to is the fact that as the market is kind of rotating somewhat down right now, we've got the NASDAQ down about 1.4%. All indices are red here. We are also seeing oil rise again. Oil Brent now, that's the international version, up almost a full 1%. And that's because OPEC is now calling for potential cuts by as much as 2 million barrels a day. And that's because as Chinese demand for oil has gone down, the thesis has been, oh, oil's going to plummet. Once we go into a recession, oil's going to plummet, oil demand, because people are going to spend less money on traveling, whether it's flying or cars or manufacturing, plastics, whatever. You know, less people buying them Barbie dolls. Well, anyway, so now OPEC originally was going to cut production by 1 million barrels a day. Now they're trying to cut production by 2 million barrels a day. Now, the actual amount of that could be a lot less because some of their member countries aren't actually producing at full capacity, so they won't be cutting. So we really only expect maybe like an 880,000 barrel reduction per day. So less of an impact on actual supply chains than what sort of the headlines are implying. But still, it's kind of just like, ugh. Well, at the same time, we're getting these mixed messages in the employment reports, and we are seeing a trend down. It's still not convincing enough to the Fed. On top of that, you've got OPEC, you know, trying to preserve their income. So what are they doing? They're pumping up inflation, basically, by cutting production. It's all very frustrating, and I think we just go back to, honestly, what I talked about in January of 2022, that's this year, and I regularly say this, but this is just it's just a shitty year where we're going to be like an anchor that's bouncing along the bottom. And I think we're, you know, when we come out of this, we're either going to be a broken anchor and we're going to be out of it, like literally we just won't want to be part of the market anymore, or we're going to come out a lot stronger. You know, obviously, I hope you and all of us watching come out a lot stronger and take advantage of investing in opportunities like House Hack near the bottom of the market, so we can go swoop up wedge deals and do so at scale. We've got some really cool things planned for that. So if you're an accredited investor, head over to househack.com, read the PPM, sign up via that DocuSign, and if you're not accredited, wait till January. Thanks so much for watching. We'll see you soon. Thanks. Bye.